Tim Lawless, welcome to The Business.
G'day Alicia, thanks for having me on the program.
Are you surprised by the resilience of the housing market in the face of 11 rate rises?
In some ways, absolutely. The housing market hasn't been resilient through the rate hiking cycle all the time. We were seeing for a while there the fastest drop in housing prices on record. Capital city values were down a little bit more than 9% in the space of about 10 months. But of course, that's all changed. We're now starting to see housing values rising, which is purely a reflection of a significant imbalance between supply, which is very low, and demand, which is now surging.
And in terms of that supply-demand imbalance, is that what's encouraging vendors to auction in the hope that they will be able to get a better price?
Well, that's definitely a big part of it. There's not a lot of competition for vendors at the moment. We're seeing listing numbers very low, which is probably another reason why we're seeing auction markets quite strong and a little bit more active seasonally than what they have been previously. Listing numbers are very low, selling conditions seem to be pretty good, and you'd have to argue that a lot of people thinking about selling will be doing it now rather than waiting until the traditional active period of spring when there might be a lot more competition to sell.
Well, home prices in major capital cities are already up a couple of percent from the lows of February. Clearance rates being higher now, are they going to translate into higher prices going forward?
That's generally how it works. There's a really strong correlation between auction clearance rates and housing price movements. As you say, Alicia, we've been seeing clearance rates holding around that high 60% range and now into the low 70% range over the past couple of months. And we're already seeing some upwards pressure on housing prices that, if anything, at the moment looks like it's gathered some momentum rather than slowed down. So it does look like the stronger clearance rates, along with other vendor metrics like faster selling times for private treaty sales, smaller discounting rates, just really do suggest that vendors are getting a little bit more leverage back.
Well, we're seeing record migration into Australia and constrained supply, as you say. What's that doing to buyer attitudes? Is FOMO back?
Well, I'm not sure if FOMO is back just yet, but it does seem that buyers are becoming more motivated to become active. And I wouldn't be surprised if that sense, that fear of missing out or FOMO does become a little bit more pervasive. As demand picks up against, as you say, overseas migration so strong, but also really, really tight rental markets, there's probably a lot of renters who are trying to fast track their purchasing decisions as well. And like we were talking about before, they're competing for a very small pool of available homes that are advertised for sale. So I think a little bit of urgency might be creeping back into decision making, which I think would be another factor supporting housing prices at the moment.
Well, if we have a lot of demand and limited supply, what's the biggest constraint on the housing market then at the moment? It obviously has to be borrowing capacity given the high levels of interest rates we're seeing.
Absolutely. Demonstrating an ability to service the loan is going to be one of the biggest hurdles that prospective buyers are facing. Of course, interest rates are very high, but prospective buyers are being assessed at an interest rate that's 3 percentage points higher than that to make sure they can pay it back in case rates go up even further. So qualifying for the loan is probably the biggest hurdle, but there's also very low sentiment. I think that's another factor in the market that is probably placing a bit of a lid or dampening some of the exuberance in the housing market. We're still seeing consumer attitudes quite depressed. Sure, housing sentiment has started to lift a little bit, but still, I think with sentiment as low as what it is, we shouldn't expect there's going to be a material lift in domestic buying activity, at least, until we start to see some more confidence returning to decision making.
So does that mean if the RBA starts to cut interest rates, we're going to see substantial pickup in the housing market, given it's not doing all too badly in the face of very high rates?
I think that's exactly what would happen. If we do see a rate cut, I think that would be the catalyst that we'd expect to see a further upswing in housing prices. Of course, we're not expecting a rate cut anytime soon. There's still some speculation that rates may even rise a little bit further from here. And even just the broad range of interest rate forecasts from economists just highlights how much uncertainty there is in the economy at the moment. Some predicting further rate hikes, some stability, some cuts later this year. So I think that probably just adds to confidence being as low as what it is. But to your point, if interest rates do fall from here, I think that would be the trigger for more buyers and sellers coming back into the marketplace and sentiment really showing a material pickup.
And what's the risk here? Of course, we just saw a slight tick up in the unemployment rate. Any forced selling means there'd be more stock levels on the market. Is that something you foresee could happen?
I think we'd be naive to think that there isn't going to be a rise in motivated selling or a rise in mortgage arrears. But off record lows, coming through the end of last year, 90-day arrears rates were sort of around 0.5% to 0.5 to 0.6% across most banks. I think that will lift, but probably not to remarkably above 1%, maybe not even above 1%. Even through the worst of the downturn in WA's market, where values fell 20% and employment was much higher, we didn't see arrears rates getting much above 1%. So my guess is most homeowners or most borrowers will probably keep up to date with their mortgage repayments, but that will involve pulling back pretty sharply on their discretionary spending, something we're starting to see a little bit of, but probably not enough to bring inflation down.
And just briefly, what's your outlook for the auction market? Are we expecting to see clearance rates hold around these 70% levels in the next few months?
I think that's probably the most reasonable outlook at the moment. We are seeing auction volumes picking up a little bit at a time when they're normally starting to drift lower, moving into the cooler months. There's clearly been an upwards trend in clearance rates from late last year. Clearance rates were down around sort of 50 to 55%. They're now consistently in the high 60s, even last week getting up into 70%. The major auction markets like Sydney and Melbourne holding above 70%. So it does look like clearance rates are on an upwards trajectory against this backdrop of very low supply and high demand. And if we see listings holding fairly low through winter, which is probably likely, I wouldn't be surprised if auctions hold around that sort of early 70 mark, maybe even getting up to the mid 70% range.
And what about spring?
Well, spring's going to be interesting. I think if history is anything to go by, normally spring's a very active period for new listings coming into the market. Spring didn't really happen for the property market last year, so you'd have to argue there's some accrued supply building up from people who are thinking about selling. My guess is if the market remains relatively buoyant, we will see a very active spring this season, which absolutely could dampen clearance rates as more supply comes into the market.
The RBA noted that rising asset prices, namely housing, was one of the reasons it lifted interest rates this month. If what we're seeing with rates at 3.85% is reasonably high clearance rates, what's going to happen when it starts cutting?
Well, I think if the RBA does start cutting, you'd probably expect there's going to be a lift in consumer sentiment. There'll be more listings coming into the market, but probably also more domestic demand coming back. Arguably, those two factors could equalise or level out the level of exuberance in the market. More listings, I think, getting back to more normal levels. Remember, listings at the moment are about 20% below average for this time of the year. If we did see more stock coming into the market, I think that would probably be met by a commensurate uplift in demand as well. So we're not really expecting to see a surge or a material lift in housing prices unless interest rates start to come down. And my best guess for that would be either late this year or early next year would be the earliest we'd see that happening.
Tim Lawless, thank you so much for your insights.
Thanks, Alicia.